right now is anticipating a generally benign CPI data, right? You're seeing lots of risk flows on in equities. Euro is a little bit stronger. We'll go through the currencies as well. But the general assumption here is we've had a lot of data that has fallen off a cliff. I think, let me just go see if I can find my own Twitter. Let me just find myself here. Rents have declined. Used car prices, this is all U.S. data, obviously. U.S. car prices have really fallen hard, and gasoline prices have fallen hard. So the conventional wisdom basically is that data is going to start to finally go down, which is really huge. And that's going to be very, very important for the market. What's really going to be interesting, I think, is not so much that if the data is down, but just how much. As always, what really matters in the market isn't the absolute number, but the number relative to expectation. So expectation right now is for actually a slightly negative month over month, 0.1 basis points on the CPI. The problem, or I think the risk in the market, is if it doesn't happen, if we're just sort of flat, or if actually we have, I have all my well, actually I can't kill all my alerts. So you guys just have to bear with my alerts, because I'll explain to you how I trade and do all my alerts in just a bit. But what I was going to say is the thing that you need to kind of appreciate is that the risk here could be to the upside. Everybody's already positioned for a soft CPI number. If the inflation remains stickier than we imagine, that's going to be a real big problem for the market. So we kind of have to really, really be aware that there is some negative shock risk possible. Now, if it does confirm, actually, and there's two ways it can go. If we actually have better than expected declines in CPI, that could be massively positive, because at this point, the market is still very short risk assets, still very, very negative equities, and still very long the dollar, So if you get a really, really sharp CPI, maybe the dollar gets a little bit of a decline. Although, having said this, I got to tell you, it doesn't matter what the inflation number is. I mean, there's only bad news on the inflation number that can happen to us, because even if the inflation is like minus 0.5%, just a sort of significant shrinkage in price levels, it's not going to matter, because the Fed is gung-ho on raising rates 75 basis points. The Fed now is sort of, I think, in this very interesting position where it decided it's going to raise rates hard early so that it can stop early. The Fed, to understand what's going on with the U.S. Monetary policy, you have to understand that under no circumstances could the Fed really raise rates above 4%, because U.S. debt is so large. The servicing of the U.S. debt at 4 to 5% interest rates will be so expensive, and the Fed will have to monetize so much that it could create much worse problems. Because remember, we're coming off of very, very low interest rate financing, right? If you go from 2% to 4%, your debt service costs, forget about just paying off the debt, your debt service costs double. So you go to like $500 billion in interest rate payments. That's extraordinarily expensive, even with government money, because you still got to print that money. And so the Fed is, I think, very, very focused on making sure that what happens is they kill inflation early, they raise rates to like 3.5%, and just keep them there at that level so they can finance government deficits for the next several years. I think it's an intelligent strategy given their choices, but you have to be mindful of the fact that it doesn't really matter what the economic data is. The Fed is going to really go hard. What's bad is if the data is much worse, and then the Fed's idea that, okay, we're going to cap it at 3.5%, 4%, comes into trouble. That's where they lose control of monetary policy, and that's what you need to be really, really aware of, right? So I wanted to just sort of let you guys know about that, because that's an issue that everybody's going to be worried about as we go forward.